we read the executive summary, see if we like that, then we have a phone conversation, and then we have a meeting. So the face-to-face meetings get more and more rare because the amount of deal flow is so high. I see 5 new deals a day. You can imagine I have to reject 3 a day or there's no way of keeping up. So 2 a day kind of go down the assembly line. And by the time we set up a meeting with the company, we're pretty impressed already with what we see.
So I just follow up. What's the attrition rate? I want to hear the funnel. How many do you get? How many do you read? How many do you see? How many do you fund? How many are successful?
So.
Okay, come on. Inquiring minds want to know.
So we see 5 a day, and I have another fund, an angel fund like Mike's, that helps me called Baseline. So please don't think that I do all this myself. Baseline has 3 people who basically rely and process all my deal flow because it's so massive. Because I've invested in 500 companies, think about 500 companies. You have 5 people on the management team, 5 people on the board of directors. That's 10 people per company times 500. There's 5,000 people in Silicon Valley who, when they go to start a company, they go, oh, why don't we go back to the guy that did our last one? And so that's why the deal flow is so massive. My deal flow is actually very high quality. These are all people I know. I triage the deal source right away. Hey, that's a, when Mark Andreessen sends me a deal, which he does like once a month, that's a high quality deal because it's already passed his screen. He wants to see if I want to co-invest with him. But back to the question. So 5 a day are coming in. We try and get rid of 2.5 to 3 right at the get-go. And then the other 2 to 3 will go on this assembly line where myself and the Baseline folks will evaluate the executive summary. That's why you have to have a great executive summary with a great elevator pitch. If you can't communicate via writing exactly what this company is doing, you're not going to get through the system. So if we like the elevator pitch, we'll kind of vote on that. One of the folks from Baseline or myself will call the entrepreneur, chat about the company. We'll probably be doing a couple of backdoor references. I'm huge on backdoor references. Oh, this guy came out of Yahoo. I'm going to go call some of my buddies at Yahoo and see if this person's well respected. We do all that in the background. And then if it passes that stage, then we'll take a meeting, and then we'll invest. So let's say we do 1 investment a month. So 5 times 30, we see 150 deals a month. 1 gets a check written. So that's kind of the funnel. Right now, in the last 2 years, I've invested in 125 companies. There'll be two or three rock stars in there. Facebook's definitely going to be one. Dig would be another one. That's one that Mike and I are in together. But basically a third. A third of the companies are going out of business. When you start a company, understand a third of them go out of business. I do not get upset when companies go out of business. I feel sorry for the entrepreneur. I hope they learn from their mistakes. But it is a fact of life. This is a risky business. And then a third of them usually return the money back. So I had an entrepreneur yesterday saying, oh, this is awful. I'm going to sell my company. I'm only going to give the investors their money back. I said, well, what are you talking about? You're already above the law of averages. You're in the second quartile of success. And then about a third of the companies will return 3 to 5 to 10x your money back. That top third pays for the other 2/3. So lots of mistakes get made in venture. That's what it's all about. It's about taking risk. But in the end, that top third, if you have 1 hit, it's definitely a hits business. If you have 1 hit per investment cycle, and I've been very fortunate to have 1 hit per cycle, it pays for the entire rest of the portfolio. So you really are looking for the hits.